All right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack, CPA and founder of Better Books Accounting and Tax Planning, where it is our goal to eliminate the confusion, the overwhelm, the overpayments that come with not knowing the tax code and not aligning yourself with the right tax professional, the right tax knowledge. Here at Better Books, we have found that many real estate investors are often frustrated and concerned with their tax payments or their lack of relationship with a tax accountant. And so we are here to build confidence, increase your knowledge of the tax code while also developing a strong relationship with a CPA and certified tax planner who is working for you rather than the IRS. If you get any sort of value out of today's episode, or you know of somebody who might want to learn more about today's episode, go ahead and share it with a friend, and also do us a favor by leaving a 5-star rating and review. That really helps us get in the ears of listeners like you or the eyes of viewers like you if you're watching on YouTube. And we just thank you in advance for doing so. We really can't do this show without you guys. So in order to provide the highest value, or in an effort to provide the highest value, today's episode will be focused on one that is increasingly more important. And that is this idea of the different tax buckets. You see, there are different accounts out there on the general marketplace. And I'm sure as investors, as business owners, you've been exposed to most of them, but maybe you don't know exactly what the benefit or the drawback of each are, what the requirements of every account is. So today we're going to do kind of a grand overview of different tax buckets, some of the accounts that are included in some of these tax buckets in order to equip you, the listener, the viewer, to make confident decisions, timely decisions, understand the implications of the decisions that you make. And so without further ado, we can jump right in the different tax buckets that you should be aware of. There are 3 that I'll be focusing on today. The first is tax-deferred, the second is tax now, and the third is tax-free. We all like to hear of the third one, but I'll be going into the first 2 so that you can have a general understanding of each. And the greatest thing I can do is to equip you with the knowledge that there are uses for each of these tax buckets, and it's important for you to be aligned with a strategic tax planner, a certified tax planner. If you don't know what that is, we went over this in an episode on the difference between tax projections and tax plannings. I encourage you to go listen to that. But essentially, a tax planner is one who works with you around the calendar. They understand your unique tax profile because all situations are different. Tax advice is not one size fits all. It really requires people to get to know you and your situation, your dreams, your pains, and ultimately come to the conclusion of a comprehensive tax plan. Part of tax planning is understanding these tax buckets. So tax-deferred, this is one that is very popular. You see these a lot in your W-2 jobs. A lot of the corporations have given their employees the benefit of a retirement account, and it usually falls in this account. These are the things like 401ks, traditional IRAs. They are accounts that allow you to put money in this account, get a tax deduction in the current year, and eventually pay taxes in future years when you go to withdraw. We actually did a deep dive into things like the 401k with the creator of the 401k, Mr. Ted Benna, on a previous episode. You can go and search in the library, just search Ted Benna or 401k, and it should come up. And we did a deep dive as to what he created the 401k for, why he created it, and some of the uses that it has today, and also some of the abuses that it has today. Because if you meet with certain professionals, or even if you just take the advice of your corporation, if you are a W-2 earner, not many of our clients are, but even if you're meeting with a retirement advisor and they're trying to give you a retirement plan to create for your employees, chances are a tax-deferred is going to be top of mind for them, mainly because it is one of the most traditional ways of retirement and has been one of the most traditional ways of retirement for years. But what you need to know about tax-deferred, it is great in the fact that it offers a tax benefit in the current year, right? You get to decrease your taxes in the year that you put money into this account, or better yet, some of them offer savings up until the deadline of your tax filings. At the time of recording, this is February 12th, you could put money into a tax-deferred account, qualified tax-deferred account, and get a tax deduction for your 2023 taxes. So that sounds great, right? And a lot of tax professionals, a lot of tax advisors have given the advice of, hey, you should contribute to a retirement account because you're going to decrease your taxes and it's going to come to you in the form of a greater tax refund or a lower tax bill. And that's great. I'm all for lowering a tax bill, but I do it in a way that takes the whole situation into account. And what a lot of people don't understand or don't fully know about tax rates and future tax rates is that they are the lowest that they have been in history right now, and they have great likelihood of increasing in the future. I can't tell you what's going to happen in the future, but if we consider where we are in the United States of America as a country, as the economy, we know without a shadow of a doubt that we are in great debt. If we haven't reached it, we are on the fringe of reaching $34 trillion of debt. I heard recently that China just bought US Steel, like one of the great companies that built up what we know as the traditional American economy today, went underwater and was bought out by a foreign country, not just a foreign country, but a country that is a threat to the United States. And so we know that the government has to work to improve the economy. And oftentimes they do this through the use of tax rates and taxation to the people. It's not my ideal fiscal policy. If you are a frequent viewer or listener of this show, I like to incentivize economic activity by lowering taxes, and that's what I would pitch if I were running the show. But oftentimes Congress and the United States government looks to increase taxes so that they can, in theory, increase revenue and pay down some of this debt. So if we know that we are in the lowest tax rates of all time, and we are also in the highest amount of debt of all time, we can draw a conclusion that tax rates are likely to increase. And we can also know that at the end of 2025, when the 8 years that were implemented as part of the Tax Cut and Jobs Act, where we saw a great tax overhaul and saw a decrease in taxes, tax rates for individuals and families went down as a result of the Tax Cuts and Jobs Act. That is set to expire come here in 2025, and they will go back to their traditional rates. So even in the next 2 years, if nothing happens, we know tax rates are increasing. So if you are taking the advice of a traditional retirement advisor or somebody selling you a retirement plan saying, put money in a 401k because it's tax deferred, yes, you're going to receive a decrease in your taxes now, but you will also be paying taxes on this in the future when you go to withdraw. And this is the tax deferred bucket. Decrease taxes now for the trade-off of taxes in the future. And we don't know where taxes are going, but in 2025, if nothing changes, we know that they'll increase just a little bit. And then if the current economic situation tells us anything, we can know that they are likely to increase in the future. So while tax deferred is not a terrible idea in its entirety because it decreases taxes now, you have to be aware that taxes in the future you will be paying, and we don't know what those future rates will look like. We can guess and say that they'll increase, but we may be wrong. So you are running the risk of trading a tax deduction now for a tax payment later, and you don't know what that rate is. That's the first bucket, tax deferred. It is great in the fact that it can decrease your taxes now, but you do have to pay taxes later. And a lot of CPAs or tax preparers or people who just want to give you quick advice will tell you put money in a retirement account so you can pay taxes, you can get a tax deduction now, and they'll do this so that you get a greater refund or pay less in taxes and their value, perceived value, goes up. But come 20, 30, 40 years ago from now, when you go to retire and that CPA who you got the advice from is now retired or dead, the way that the CPA is an aging population, they're gone, and now you're left with a tax bill that you have to deal with. So this is what happens with the tax deferred accounts. I'm not saying that they're all bad. We do recommend them for some of our clients, but it's when we come with a full picture and a full understanding, and we equip you with the knowledge that, hey, this is the trade-off you're making. Let's maybe look at some of the other tax buckets and see what the best decision is for you. So tax deferred is the first bucket. Tax now is the second bucket. And this bucket, nobody likes to hear that we have to pay taxes now, but there is some great benefit. And these are accounts like your Roth IRAs, your Roth 401ks. You don't pay taxes, or you pay taxes now, but you don't pay taxes in the future, right? I did a full episode on Peter Thiel, the founder of PayPal, and how he used the Roth IRA to create this massive tax-free bank account by taking his Roth IRA and investing the funds in PayPal when he first started it. And now PayPal has been bought by eBay. He then invested in Facebook. Facebook's gone up astronomically, and now he's at the point of having about $6 billion in a tax-free account that he won't pay taxes on when he goes to withdraw that money when he reaches age 59 and a half here in 2027. So understand that you, yes, have to pay taxes now, and you do that in the form of a paycheck, or you do that in the form of tax payments at year end or estimated tax payments. You're paying taxes on the money that you're making now and then converting it into your Roth IRA account. But the goal is to put money in that account and then have this money grow over 10, 20, 30 years, 40 years. And when it comes time to withdraw, once you reach the age of 59 and a half, then you will get that money to you tax-free. So you don't pay taxes on it. And that money is bound to increase through the use of compounding and the stock market and the way that our economy works. So tax now sounds bad when you think of it, and it's not going to give you the highest refund right now or the lowest tax payment right now. You will pay taxes, but the idea is that you're trading that for a future tax-free lifestyle. Now, a lot of these accounts come with limits. Same with the tax-deferred, is you can only contribute a certain amount. I think in 2024, it's $7,000 to your Roth IRA. So, and there's limits on how much money or who's able to contribute. The Roth 401k is another great option for some other people. But the idea is that there's a tax-deferred bucket and there's a tax now bucket. And don't be afraid to contribute to a tax now bucket, even though you have to pay taxes now, right? Again, we have been brought up, and it's part of our nature to want immediate gratification. We don't like patience. We don't like the idea of endurance. We don't like the idea of saving for the future. These are ingrained in our sinful nature. As a Christian, that's what I believe, is that we have sin in us, and the Spirit of God needs to come into us to give us the spirit of patience and the spirit of kindness and the spirit of love and self-control. And it takes great patience and self-control to put money aside, to save for the future, to pay taxes now, knowing that in the future you will be growing a great amount of wealth, and it's going to come to you tax-free when you go to withdraw in those retirement years. So we have tax-deferred, we have tax now, and the third bucket, everyone's favorite bucket, is tax-free. Now, hear me when I say this. Tax-free sounds great, but it comes with great stipulations. And sometimes tax-free isn't always tax-free, right? There are accounts that traditionally are tax-free for most people. The HSA is a great option. Now, if you're a 2% or more shareholder of an S corporation, you won't get the same tax benefit in the HSA as somebody who's a wage earner and receiving it from their corporation, but you still get a tax benefit, right? You get a tax deduction now on your personal tax return, and then the money grows. You can invest this money in the stock market, in real estate, depending on the account, and it will grow. You can start to accumulate wealth and earnings in this HSA account, not pay taxes. You don't have to pay capital gains on the increase of wealth that you have in this HSA account. And then you can withdraw it tax-free through the power of an HSA for qualified medical expenses, right? So you get a tax deduction now, it grows tax-free, and then you withdraw it tax-free to pay for qualified medical expenses. So it's not like you can grow it tax-free and withdraw it tax-free and spend it on whatever you want. There are restrictions to the way that you use this money, which you need to account for. You need to think of when you're planning around this, but it does grow and get withdrawn tax-free for qualified medical expenses at any point. This is not something that you have to wait 59 and a half years to tap into. You can do it at any point to pay for qualified medical expenses, but the same thing goes, right? Compounding and patience does well in these things. So oftentimes I recommend paying for medical expenses out of pocket with money that you have and not in your HSA account, because then you can allow your HSA to compound more, and then come your retirement age, when you're going to the doctor more often, probably paying for more medical visits, and you might have more medical procedures, you can use this as a retirement supplement and not have to withdraw from the 401k, or not have to use the tax-free withdrawals from your Roth IRA for medical expenses, right? So the HSA is a great tax-free, no tax account under the guidelines that's set forth. Now, another tax-free that we have talked about through an episode that we did with Mr. David McKnight, you should see that soon on the Know Your Numbers REI podcast. He is a very large proponent of life insurance retirement planning, using life insurance vehicles to plan for retirement. And I would not say that these are tax-free, because life insurance is not a tax deduction. You have to pay taxes on it, especially if you are a business owner. But it does grow tax-free if you invest it in small businesses or the stock market. It grows in this account. You don't pay taxes in this insurance account. And then the withdrawal is tax-free because it is an insurance vehicle, and there's a piece of the tax code that says that insurance benefits are tax-free. So there are 3 buckets that we talk about when we talk about the different tax buckets: tax-deferred, tax-now, and tax-free. The best thing I can say to you is meet with somebody to discuss these different buckets and see what fits you best, right? I'm not a end-all be-all this way or the highway kind of guy. I think there is diversity that is needed. And this is one thing that we talked about with Mr. Ted Benna on his episode of the 401k, right? Just like you diversify your real estate portfolio by investing in different locations or different unit types, different industries, commercial versus residential, industrial versus warehousing. You know, it's a wise step to diversify from a tax perspective. And this is what you do with a certified tax planner. This is what you do when you're thinking of tax strategy. It's not projecting your taxes out. It's not saying, hey, do this to lower your taxes. It is, hey, we're in this situation now. We're probably going to be this situation 10 years from now. What is the best move we can make to plan ahead and save on tax? This has been your latest episode of the Know Your Numbers REI podcast. Again, if you get any sort of value out of this, give us a 5-star rating and review. If you think somebody else could get value out of it, go ahead and share it with a friend. My name is Chris McCormack, certified tax planner, CPA, focusing on real estate investors. We'd love to see if we're a good fit or have the services that you need. Go ahead and check out our website and find the time to meet with our team. God bless you all. Take care and keep moving forward.